In this video, I will explain step by step, in simple and easy to understand language, how a beginner can become a Forex trader. This video will cover all the essential basics of Forex trading, starting from what Forex actually is, all the way to a detailed breakdown of economic news and its impact on the charts. Forex is the largest and most liquid market, with a daily trading volume of several $1 trillion, which is an order of magnitude higher than other markets. Forex stands for foreign exchange, meaning the exchange of one foreign currency for another. But it is used for much more than just exchanging, also for hedging risks, speculation, investments, and so on. Forex doesn't have a single central hub, like the Chicago or New York Stock Exchange. Essentially, it is a decentralized market. Its participants are governments, banks, brokerage firms, hedge funds, institutional investors, individual traders, and so on. Retail traders, which is what we are interested in speculation. That is, buying, say, euros for dollars, expecting the euro to rise against the dollar, or selling euros for dollars, expecting the euro to fall harder than the dollar. In other words, a specific currency pair is traded by buying or selling one asset for another. On what basis do traders decide to buy or sell a certain asset? Usually, traders analyze a specific situation according to their strategy and make a decision based on that. But based on what specific strategy? There are a million options here. Not only are there a million types of strategies, but everyone also interprets a given concept in their own way. I will reveal my approach and strategy at the end of this video. A currency pair consists of two assets, the base currency and the quote currency. Currency pairs are divided into three main categories, primarily by trading volume: majors, minors, and exotic pairs. The quote you see on the chart for a specific currency pair is the value of the base asset relative to the quote asset. Simply put, it is how much of the quote asset you can buy for 1 unit of the base asset. For example, on euro-dollar, we see the quote 1.06, which means that for 1 euro, we can buy $1.06. Another example, on euro-pound, we see the quote 0.85, which means that for 1 euro, we can buy 0.85 pounds. Price movement in Forex is measured in pips, which is the fourth digit after the decimal point. For example, if the price on euro-dollar went up from 1 to 1.0010, that was a 10 pip movement. One exception is pairs with JPY. In this case, a pip is considered to be the second digit after the decimal point. Also, nowadays, on almost all brokers, you will see that there are 5 digits after the decimal point. The fifth digit after the decimal point is called a pipette. Forex operates 24 hours a day, 5 days a week. The market is closed on weekends. Forex also has sessions. A session is a specific time period during the day with its own characteristic behavior, which will depend on which financial center is actively trading at that moment. We have 4 main sessions. We will look at them in New York time. Don't forget to check what time it is for you right now, whether it's daylight saving time or standard time. Asian session from 7 p.m. to 2 a.m. Frankfurt session from 2 a.m. to 3 a.m. London session from 3 a.m. to 8 a.m. and the New York session from 8 a.m. to 11 a.m. Here I am only taking into account the most active time of the New York session. Each session has its own behavioral model, and I build my trading based on them combined with context analysis. But I will talk about my strategy a little later in the video. Essentially, you can only enter 2 types of positions, a buy or a sell, meaning long or short. But you can do this in different ways. First, if you are looking at the chart and want to enter right now, you just click buy or sell in the terminal. This will be a market entry. In this case, the buy or sell order will be executed immediately at the current price. Imagine a situation. You want to enter a long position at a given point when the price drops lower, but it is still far away. For this, there is a pending order, in this case, a buy limit. You can set the desired price and it will activate when it is reached. The situation might be different when you want to open a long position when the price, say, reaches a certain level that is higher than the current price. This can also be done via a pending order, but in this case, it will be a buy stop. If you want to open a short position when the price, let's say, sweeps this liquidity pool, meaning when the limit order price is above the current price value, then you will need a sell limit order. If, however, you want to open a short position after the price drops slightly lower to this specific level, then you will need a sell stop order, which is when the desired price of the limit order is below the current price value. But these are not all the orders. When entering a position, you don't want to find yourself in a situation where the price moves in your expected direction, giving you some profit, but then sharply shoots back to your entry point, goes into the negative, and never returns. For this, there is a take profit order, which will lock in the profit at your chosen point. Also, profits can be locked in partially by setting multiple take profits along the price movement. You also don't want to find yourself in a situation where the price goes against you and you lose your entire account on a single position. For this, there is a stop loss order. It limits your losses, as your position will automatically be closed when it's reached. Setting a stop loss is mandatory, especially for beginners. Those who use partial profit taking often move their position to break even after reaching the first target, meaning they move the stop loss to the entry point. There is also a trailing stop. The concept is this: if the price moves towards the take profit by 10 pips, the stop loss will also move by 10 pips. The same thing will happen after another 10 pips, and so on. You set the specific conditions for this order yourself. But what should the ratio of the stop size to the take profit size be? By ratio, I mean risk to reward. To make it easier to understand, picture the situation like this. When you set your stop loss, it equals 1 unit of risk. For example, a 1% risk. If the take profit equals the stop loss, the risk reward will be 1 to 1, because a unit of risk equals a unit of potential profit. If the take profit is twice as large as the stop, the ratio will be 2 to 1. If the take profit is 3 times larger than the stop, the risk reward will be 3 to 1, and so on. Conversely, if the take profit is half the size of the stop, the risk reward will be 0.5 to 1. Profitability will be built based not only on your risk-reward ratio, but also on your win rate, meaning what percentage of your trades turn out to be winners. For example, if out of 100 trades your win rate is 40%, meaning 40 positions close at take profit and 60 at stop loss, with a 1-to-1 risk-reward and 1% risk per position, you will end up at a loss of 20%. However, if the risk-reward is 2 to 1, you will already be in profit by 20%. It seems like the higher the better, but alas, in reality, the more you increase your risk-reward, the almost proportionally lower your win rate will be. This is easy to verify by backtesting over a period of at least a year, using a single entry model. Sadly, for many, this simple task proves overwhelming, and they keep their heads in the clouds. There is no such thing as the best risk-reward. It cannot be better or worse. What matters is its correlation with the win rate. There is the best one for you personally when trading a certain setup. You will determine this through testing. Risk should never be inflated. Usually, traders take 1 or 2%, with a maximum of 3% risk per position. Position volume in Forex is measured in lots. Thus, one standard lot is equal to 100,000 units of the base currency. For example, in the euro-dollar currency pair, the base asset is the euro, so one lot will be equal to 100,000 euros. In the pound-dollar currency pair, the base asset is the pound. The lot value is 100,000 pounds, and so on. The value of 1 pip on some pairs will be higher, and on some lower, for a one-lot trade. This price depends on the current quote of the quote currency in your pair relative to your account currency. To calculate the pip value for your pair, you can use this formula or simply use a special calculator. Therefore, you always need to calculate the lot size for each currency pair separately. Calculating what the lot size should be in Forex is quite simple. You can use a special calculator for this. You need to specify your account currency, your currency pair, the number of pips in your stop loss, your account size, and the risk percentage per trade from your account balance, and then hit Calculate. Contrary to popular belief, the size of your leverage does not directly affect the risk on your position. Of course, high leverage gives you the ability to open larger positions, sometimes excessively large ones, but it is just a tool. Now in detail, leverage is essentially a loan that the broker gives you to open positions larger than your account balance. For example, your account is $1,000. With 1-to-1 leverage, you can only open a position for that $1,000. If the leverage is 1 to 2, then for $2,000. If 1 to 10, then for $10,000. If 1 to 100, then for $100,000, and so on. Why is this necessary? As we recall, a lot size in Forex is equal to 100,000 units of the base currency. Continuing our example, let's say you want to open 0.1 lots on the US dollar to Canadian dollar pair. The value of 0.1 lots will be $10,000. Without leverage, opening this position would be impossible. However, if your leverage is 1 to 100, then to open the position, you will only need 1/100th of the position size, meaning $100, which will be frozen by the broker when the position is opened. The frozen funds are called used margin. In this example, you have $900 left completely free, with which you can open other positions. This $900 will be your free margin. Thus, leverage gives you the ability not only to open a larger position, but also to open multiple such positions. The risk per position is evaluated not only by the position size, but in combination with the stop loss size. So if your risk per position is 1% on a $10,000 account, you will need a different lot size for a different stop loss size. A nuance for those trading on prop firms: pay attention to the fact that you will have different leverage for different assets. Also, in some firms, after transitioning to a funded account. Keep in mind that your position will always be opened in a slight negative due to the spread, meaning the difference between the bid and ask prices. The ask will always be higher than the bid. Sellers always want a higher price than buyers. Also, slippage can worsen your entry price. This all comes down to the broker you are trading through. For some, it will be higher, for others, lower. Also, generally, the larger the position, the larger the slippage. Let's talk about brokers, so you don't have any illusions about the place where you will most likely be trading. Let's break down CFDs and futures. CFDs are what, I would say, 90% of us trade. This includes Forex brokers, prop firms, and so on. The main issue with CFDs is regulation. In many places, they are outright banned. On the flip side, you get leverage up to 1 to 2,000 and no minimum deposit. But the main problem is that CFD brokers, roughly speaking, can be divided into two categories: A book and B book. And while with an A book, orders are sent to a liquidity provider and the broker doesn't care whether you hit your stop loss or take profit, with a B book, the broker trades against every single one of your positions. You make a profit, it's their loss, and vice versa. This creates a conflict of interest. It's in their best interest for you to lose. In short, B-book brokers don't route you to the real market. You are trading inside a bucket shop, the broker's internal system, and even the largest order won't be able to move the price. And yes, the vast majority of brokers are exactly like this. But there are also futures. This is a strictly regulated market where real trading actually takes place through a centralized exchange, and where a trader interacts with the real market. I should mention right away, don't get confused by the instrument names. The contract tickers for futures on the CME are different. For example, Euro-dollar is called 6E. News is a huge topic. In short, economic news comes out for specific currencies at specific times. This is news from different sectors and of varying importance, which means it has a varying impact on the chart. The question is, which news should you watch? This will all depend on your chosen assets. In currency pairs, you have two assets: the base currency and the quote currency. You need to track the news for both assets in the pair. The strength of the reaction to the news is determined by far more than just the color of the news impact. The difference between, for example, NFP and unemployment data is extremely vast. In addition to the significance of the news itself, the reaction is determined by how much the actual data will differ from the expectations for it. But what influences currency prices the most? First and foremost, it's the key interest rates set by the central banks of the countries to which the currency belongs. Raising the key interest rate, or expectations of a rate hike, gives strength to the currency, and vice versa. Also, the economic situation in a country will have a significant impact on the strength of its currency, hence the impact of news from the economic calendar, as they provide insight into the country's economic health. And thirdly, it's the change in prices of assets that the economy of a certain country is largely tied to. For example, the correlation between the price of oil and the Canadian dollar. There is a multitude of factors. These are just the main ones. Trend lines, liquidity pools, indicators, and so on do not move the price. These strategies are merely a prism through which you look at the chart and interpret its movements. You can also view information about each news event on Forex Factory simply by clicking on it. In the Forex market, my favorite strategy is trading session models. You already know what Forex sessions are, and each of them has specific models that can tell you what to expect from the next session, a reversal or a continuation of the move. Naturally, the analysis doesn't rely solely on the session pattern. I always look at the overall context of what is happening that day, which is why I use multi-time frame analysis to determine my expectations. For my trading, I am interested in just a few Asian session reversal models and a few New York session models. Of course, reversal and continuation models don't really exist as such. It is just my personal classification. So if I see a session model I am interested in, and my context-based expectations confirm this idea, that becomes my potential setup. In this video, I won't be doing a detailed breakdown of session models and my algorithm for context analysis. These are extremely large topics that require separate videos. What to do next? You shouldn't rush out and trade with real money right away. You are still very far from any success. Ahead of you are hundreds and hundreds of hours of testing, disappointments, drawdowns, and blown accounts. This will happen, don't doubt it for a second. There is no point in losing money right at the start. Open a demo account to start collecting statistics and practicing at least some strategy without risking real money. In parallel, test your strategy via backtesting. Record all positions and situations in a trading journal. Next, look for where you made mistakes and how the result could have been improved. Make changes to your trading strategy and run the tests again. Keep doing this until you have a consistently positive result both on demo and in backtesting over a long period of time. Understanding the basics is quite simple, but bringing it to a positive result is a task of immense difficulty, which is achieved by a very small minority.